Hello guys and welcome to another deep value video. Today I take an in-depth look at Oracle Corporation, ticker symbol ORCL. Oracle Corporation is an American multinational computer technology company headquartered in Austin, Texas. The company sells database software, particularly Oracle database and cloud computing. Oracle's core application software is a suite of enterprise software products such as enterprise resource planning, human capital management software, customer relationship management software, enterprise performance management software, customer experience commerce, and supply chain management software. First, let's dig deep into the business metrics. The return on invested capital is 11.28%. The return on equity is 120%. The return on tangible assets is 40%. So overall, pretty great company. The current ratio is 0.71, which is very interesting because in general, software companies do have a very high current ratio because they do not have that much inventory, and also they do not have that much short-term debt. So this is definitely an interesting case study. Um, Now let's move on to valuation. Free cash flow yield is 3.7% approximately, which is a bit overvalued, but not too far from the current average market price and valuation. The price to earnings is 36, which is above the current market average. Let's see Graham's valuation here. Introducing the 2025 estimated earnings per share, we get intrinsic value, which is slightly below the current price. So they're trading at a fair price from this point of view. Now, going on to the discounted cash flow model, we can see something very interesting here. We can see that their 2015 cash flow is actually higher than today's free cash flow, and this does not take into account inflation. Because if we did take into account inflation, then their 2024 free cash flow probably could be close to half of their 2015 free cash flow, or at least 60% of it. So this means that even in the conservative 5% growth rate, which I use, I think might be a little too optimistic, but I'll stick with it. Using this 5% growth rate, we get an intrinsic value of $55 per share. The historical P multiple is 24, and they're trading above that, which is stupid because although they've recovered their free cash flow is still a joke. So they do not deserve to be trading 50% above the average. I use the multiples of some of their competitors, Microsoft, Amazon, Salesforce, and we get intrinsic value of $137. And the dividend discount model, well, I just matched the growth rate of the free cash flow. Their payout ratio is 42%, so I don't think they'll grow. Maybe they'll grow at 5.5% to go to a 60% payout ratio, but that's it in my opinion. And now in the output, let's also introduce here the multiples valuation. And we get an intrinsic value of $101.11. Applying a 15% mandatory margin of safety, we get an intrinsic value of $85.94, indicating that the stock is a sell. Now, what do I think about Oracle? Well, first of all, Oracle is definitely overvalued. Their free cash flow is a very bad joke for a technology company. They do not deserve any multiple above 20 because a company which has not managed to grow its free cash flow in a decade is not a premium price worthy company. They do not deserve a high multiple. If you think this is a great buy, then you're delusional. Unless they get some great new product. Even then, I do not think they're priced. I think they're priced for 10% growth. Actually, let's see for what growth they're priced. So their stock price factors in a 15%, 60% actually, no, 15.5% CAGR discounted cash flow growth for the next 9 years. So do you see how absurd this is? A company which has managed to decrease its free cash flow over a decade is expected to more than quadruple its free cash flow by the end of 2032. This is not realistic, guys. You must understand that this is not realistic, and you must see what this is. This is a company which is dead. They do not deserve your money. Of course, you should do your own due diligence, but I know I'm being a bit critical for just a company, but in today's market, I almost think I'm wasting my time when I criticize people, bro. When I say to them, bro, you just got to understand, just because they're trading at a 52-week low doesn't mean anything. All that matters is valuation, valuation, and valuation. Of course, you can be like Warren Buffett and invest in quality, but today quality is so overpriced that they're priced in for 10x growth, even though they're not going to get it. The time to buy quality was in 2022 when the bubble popped temporarily. I made a lot of money from 2022, and God bless 2022. I love that it happened, but I think we need another scenario like that where the stock price drops like 20 or 30% on most companies, so that we can get those big and beautiful quality companies, just like Warren Buffett says. Those are the companies we need. Those are the companies I want, and those are the companies that I am going to buy, not Oracle. Oracle is a buy if they maybe drop to $80, and in that case, yeah, maybe they're a buy. But to be honest, I'll just keep my money. I sold everything I had. Well, not everything, but a lot of what I had at the start of this year because I knew Trump is an idiot. I'm sorry for all the MAGA voters, but he's an idiot. And since then, I kept my money in um, a high yield account, and look what happened. If I had, and also I held my money in another currency from the country I live in. And because the dollar depreciated, if I had held USD, then not only would have my stocks dropped a lot, but also I would have lost a lot of money on currency conversion from the USD to my currency at home. So now, uh, basically, I've prevented a 20% loss for myself because I knew Trump is an idiot. And also, I am now on track to gain 3% this year on currency, sorry, on my high yield savings account, or sorry, 5% actually. So I'm keeping my money. I'm waiting for great opportunities, but Oracle is not the one you're looking for, guys. I know I'm being critical. I know some of you love to attach yourself emotionally to a company, but please do not attach yourself emotionally to a company. Never, ever, never, ever, never, never, ever. Yeah, I'm. I think I got a bit on a rant today. Um, yeah, do not. So let's end the video here. I think this has been it for today. And yeah, do not forget to check out our affiliate, Ticker Data. Ticker Data is a great tool that me and a lot of my friends actually use it. Mostly me because I'm the biggest into investing, but some of my friends as well. It's the tool I've used today. So you have this place where you put in a ticker symbol and you get all of this financial data. You have grand valuation, discounted cash flow, historical multiples, multiple valuation, DVDM, and you also not only have this cool API, you also have a lot of other templates. So you have a personal portfolio tracker, you have a bank valuation model. There are a lot of models out there. It's templates, sorry. It's a great tool. It's also pretty cheap. I suggest you check it out. I have the link in the description below. And yeah, it's a great tool. Also, do not forget to check out my investing blog. Soon I'll be releasing an interesting, very interesting article, perhaps, on the current market valuations, and also in that article, I will discuss the economic state of the United States from the perspective of Trump's policies, and I think, and the effect I think it will have on the stock market. And yeah, this is coming soon, in a week at most. Yeah, I hope this has been it for today. I think this has been it for today. Hope to see you in the next video. Bye.